Well, welcome everyone to the Bell Asset Management webinar, Global Small and Mid Caps, the Strong Getting Stronger. My name is James Biggins and I'm a Sales Director here at Channel Capital. We are the distribution partner for Bell Asset Management. For those of you that don't know, Bell Asset Management is a global equities manager based in Melbourne with two investment strategies. We've got the Bell Global Equities Fund and the Bell Global Emerging Companies Fund. Today, I'm joined by Ned Bell, CIO of Bell Asset Management, who will be providing some thoughts around post-COVID-19 and why the stronger companies are getting stronger, a market outlook and looking at some sectors and specific stocks that represent the best ideas and earnings ahead. We've also got why portfolio positioning and why quality to reasonable price approach is poised to do well as we enter into an inflationary environment, and looking at some of their highest conviction stock ideas in the portfolio. I'll give a quick brief background on Ned. Ned has over 20 years of experience in the investment management industry and is primarily responsible for the overall return outcomes of client portfolios and providing investment leadership. Ned is also responsible for recruiting talent, organising, mentoring, and the investment team in the Bell way of managing assets. I think more broadly, when we talk to investors, we see a number of reasons why global small mid caps are still attractive. And I think three of the kind of things to think about is that there's still strong growth potential, which we'll go through later in the presentation. We also see probably less valuation risk than other asset classes. And then also it adds to diversification to portfolios. When you've got those kind of tailwinds, and then you start to look at the way that Bell manage assets and define this mid cap universe, we look at it from a point of a market cap size, so nothing less than $1 billion. We're looking at a return on equity of 15% or greater for a consecutive 3 years. There's a quality score, and we also have a fundamental and quality test as well. So when you look at that type of outcome, we really think it's going to have strong long-term returns for investors. Now, the webinar is going to run till 1:15. As we're all experts on Zoom, you can submit your questions beforehand. This will be... Matt, if you can flick across to the next slide just with the important information, please read that at your own time. Thanks, Matt. But Ned, good afternoon. And I thought I'd start on some questions just around the broader part of where we are in this kind of, earnings recession fading away and where we are in that mid cap market.
Yep, absolutely. Thanks, James. And thanks to everyone for joining. So I'll start off with, I think, one of my favourite slides that touches on this exact point, which is, like, where are we in the earnings recovery? And really the purpose of this chart is to draw some attention to some similar earnings drawdown periods. So at the risk of stating the obvious, last year was a tough year for global earnings. So global small cap stocks earnings fell by a bit over 50%. Global equities as a whole fell by, close to 30%. And what we've done here is we've looked back at the last two big earnings drawdowns in global equities and the subsequent performance in different parts of the market in the next 1, 3, 5 years. So there was obviously post the dot-com boom and bust in the early 2000s and post the GFC. And what we saw there in that dark green or turquoise, I'm a bit colorblind, bars, is that if you bought small mid-cap stocks after one of these earnings drawdowns, there is, in the subsequent 5-year period, the returns were a bit over 200%.
Yep.
So then that brings you back to, okay, so where are we now? So clearly they have had a huge bounce off their lows, but the point is that if you go back to, say, pre-COVID highs in March of last year, the asset class is only, I think it's 26% above those previous highs. And it's 27% above where it was in March 2018.
Right.
So over a slightly longer time period, the asset class still hasn't done very much. But the main point to leave you with is that the earnings recovery that we're going to see has still got a long, long way to play out. And as the earnings continue to recover in the way that we expect, we think that's just going to continue to drive really, really strong performance. And so that's why we basically brought up this chart. And maybe if we can just turn to the next page, this really just sort of amplifies let's call it the earnings journey, if you like. And so at the top left there, we basically looked at how the earnings numbers have changed, or we expect them to change for the MSCI World Mid Cap Index as a reference point. And again, you can see there that 2020 was saw earnings fall by 53%. Big recovery this year, but the main point is in 2021, I mean, $91 a share. I mean, that's still a fair way above the pre-COVID highs. So, and I don't think the market's quite on top of this. They're not sort of acknowledging the fact that the earnings recovery is very, very steep. And then you move out to 22, 23, and again, the earnings trajectory has still got a long way to play out. So I think that's kind of the one of the big points we think that market is missing is the strength, not only the strength, but also the longevity of the earnings recovery. And then if you look at those 22, 23 numbers, those estimates, and those are consensus numbers,
Right.
not ours.
Okay.
They've been drifting higher in the last, say, 3 to 6 months. And one of the big things that's driven that has been just the last earnings season, in Q1, was probably one of the strongest I've ever seen. I've been in this for 25 years, and you can see there that some of the points I've made there is that, for example, in the Bell Global Emerging Companies Fund, the average earnings beat was 15.7%.
Right.
So
Material.
It's
Yeah.
very material. And, some of the names we've talked about before in the past, but you have companies like Pool Corp, Yeti, Tractor Supply, a few others there, they beat by 30%, like on average. And so the magnitudes of the beats are very, very big. And I think, one of the consensus views is that, okay, earnings, last year got clobbered. They're going to bounce back, and then everything's just going to normalize.
Plateau. Yep.
Everything's going to plateau. Everything's going to flatten out. But from what we're actually seeing, kind of on the ground, is that the steepness of the earnings recovery has still got a ways to go.
Yep.
And if you think about coming back to just the economic growth, I mean the US economy is going to grow by basically about 6.6% this year, 4.5% next year. So as much as that growth rate's decelerating, 4.5% still not a bad number. And so I think there's really very strong economic underpinning, but also and we'll come to a bit later, but the actions some of the companies have taken, particularly in regard to lowering their cost bases, that has not been appreciated as much, because what it means is that when the economy ticks up and revenue accelerates off a lower cost base, the earnings leverage is huge.
Yep.
And that's a real, really important point. And then just on valuation, you mentioned it, James, but the valuation of the asset class, it's on just under 21 times earnings. So when markets are, trading where they are, that everyone's asking themselves the same question, which is like, where can I find, where are the uncovered gems,
Yep.
Where can I still make money? And we still feel like, the asset class has got a ways to play out. And on the top right there, that table, basically what we're trying to do is just to give people a little bit of perspective about how much upside is potentially there if, say, you just apply that current PE of the market 21 times to 23 EPS. Consensus, again, that's it. Still 25% upside. If you get a bit more adventurous, apply a 25 times multiple, 48%. So there's still upside. That's kind of the big point we want to make.
Yeah, it goes back to the previous slide. We're still 1 year into a 5-year kind of recovery.
Correct. Exactly right. Exactly right.
And then I guess I know the title of our presentation is "The Strong Getting Stronger," and I know you've listed some names here, but it'd be great to kind of get some thoughts around, what that looks like and how they're going to continue to build out and make the street second guess those numbers that they might have as consensus.
Yeah. So it's a good question, and I think and maybe if we can just turn to the next page, this sort of brings out, I guess, or puts a bit more clarity around the types of names that we own and what we're seeing. And so I think, as I mentioned before, like clearly the magnitudes of the beats. Q1 was amazing. We're just coming into Q2 earnings numbers now, and this is typically when management start giving a little bit of guidance into next year. And if we look at guidance for next year for a lot of the companies we're investing in or we're looking at, it's still factoring in a much more subdued outlook in our view. And so we think this earnings upgrade cycle has still got a long ways to play out. And if I was to look at these companies here, clearly, look, we own all these companies, but the biggest earnings test of all time was last year. So again, in a year when earnings fell by half, these companies, these 18 odd companies, they actually, on average, they grew revenue by 7.5%. They grew earnings by 18.5%. So what does that tell you? I mean, amongst other things, it tells you that their earnings are a function of their franchise, number one. Number two, they're not nearly as cyclical as the rest of the market. And number three, it comes into this theme of the strong getting stronger. And what we've seen is that, that a lot of those companies we've got exposure to, they've actually benefited from COVID. Like they've actually got on the front foot, put their shoulder to the wheel. So it's not just about cost cutting. They've actually benefited from wallet share bleed away from much weaker operators towards the stronger operators. Companies like Yeti, which I've spoken about a lot, they used as an opportunity to spend on their omni-channel presence. Now their direct-to-consumer business has gone from something like 43% to 56%. With that comes much higher margins. Tractor Supply, terrific retailer. Again, they spent in the face of adversity, and what that meant was, so last year, for example, they picked up, I think it was 9 million new customers. 9 million new customers last year. And coming back to the sell side, which often doesn't look beyond the end of their shoes. But the company, what they're saying is that these customers kept coming back. They haven't just come back once. They haven't come to us once and never seen them again. They're coming back again and again and again. So it's that longevity of the market share that I think is not really factored in. So, and then again, you look at these companies and when people talk about small mid cap stocks, there's a huge funnel of types of companies. There are companies very much in their infancy. There are much lower margin businesses, but these companies as a whole, if you look at them, these guys, their average long-term growth rate's about 13%. They generate 18% return on capital. They've got next to no leverage, and they're trading on free cash flow yield of about 3.7%. So they're not that expensive. Yeah. So
relative to the market.
Yeah, correct. Exactly right. So look, those are a couple of the big points there. Just on the next page brings it out a little bit more that, and again, these are the characteristics of our portfolio. And this slide doesn't look all that exciting, but I just want to reiterate a couple of the key features of the strategy in that. So at the top left there, the quality metrics of this portfolio, they're extremely high. And one of the reasons that our companies, the earnings held up so well last year, is that they've got great franchises. I mean, they generate as a whole, we've got a bit over 40 names, very high levels of profitability, without much leverage, great ESG characteristics. The growth metrics on the bottom left there, again, we don't consider ourselves growth managers per se, but the actual growth outcomes have been very good. And, one of the reasons the earnings growth, for example, been so far ahead of the benchmark is because we did suffer that huge drawdown last year. And again, you look at the asset class, and it should be looked at as a growth, playing a growth role in portfolios. I mean, these companies, it's a reminder, they're in this sweet spot where they're growing their revenue at like nice clips at 8, 9, 10, 12%. And even with last year's drawdown, our companies have still delivered that. And then the valuation metrics are still pretty attractive. So I think when we think about the portfolio, it's still in incredibly strong shape. The market cap of the portfolio is a little bit higher than the benchmark, but it will alternate. One of the reasons for that is, frankly, we're finding much better value for money, probably in the mids at the moment.
Yep.
It's usually when you get a bit more of a drawdown is when the smalls fall out of favour. But the small cap guys, the small cap growth stocks, for example, trading on 33, 34 times earnings, like they're just too expensive at the moment.
Correct. And then I guess from here, what sectors or where are you kind of seeing the next kind of targets, and maybe even just walking through some of the newer people on the call, or investors, just around that quality at reasonable price and how that gets the numbers where you are here.
Yeah, so this is on that last part of the question. I mean so just back to the characteristics page.
Thanks.
Oh, thanks, mate. So this is what quality at reasonable price really looks like.
Yep.
So the top left, quality, for us means, I mean, you can talk about moats all you want, but it comes down to the profit those companies generate and what's leverage. So again, this portfolio really consists of the best of the best, small mid-cap companies globally. And again, we have got that valuation discipline. We're not paying ridiculous multiples. We still feel like, I mean, coming back to where we are in the cycle, Valuation risk is something that, it's much more important now than it would have been 2 or 3 years ago. And as much as having a valuation discipline probably hasn't been much of a help for us the last couple of years, going into a rising interest rate environment where, rates are picking up, inflation's picking up, I think you look at the inflation rates, CPI ticking up around 3.7%. I mean, we haven't seen that for a long time, but historically what happens is when you see that is the most expensive stocks in the market, they compress meaningfully, multiples compress, and often particularly with the faster growing names, that overlaps with when growth rates start to flatten out. So that's the double whammy where, you can really do yourself some damage there. So we don't have that exposure. We've reduced our exposure there. So that's really what quality of reasonable price looks like. The following page really fleshes out the, how we're positioned from a regional and sector perspective. Regionally, it's, from a geographical perspective, that's just happens to be where we find the best companies. Yep. It's not really a macro view in any way, shape, or form. From a sector perspective, a couple of points I'll make there. First of all, we've got very good absolute diversification. What's probably a bit surprising to some might be that if you look at the IT exposure, that's actually our biggest overweight. But one of the reasons we're there, we actually find really good value there in the small mid-cap names because like the IT names we've got, I mean, they are quite different. They tend to be more consulting businesses. You can see Genpact, CGI, there's a few others there that they have not taken off in the same way that some of the large cap tech names did last year. If anything, they've had their pipelines have been pushed out a little bit into this year. So the earnings hockey stick for these guys is more likely to happen second half of this year, first half of next year. And again, the valuations are not too bad. So for example, like our IT stocks, I think the free cash flow yield of our IT names is about 4.1%, which is unheard of in large cap growth world. But it's not just about IT. Clearly, we've got good exposure to things like healthcare, consumer discretionary, consumer staples, consumer discretion we've spoken about. But to me, that's like, particularly in the US, that's a bit like the what's happening now. It's a bit like you're awakening the sleeping giant. The US consumer accounts for about 70% of GDP growth of the economy, and then just looking at the GDP numbers for this year. I mean, as I mentioned, the US will grow about 6.6% this year, but consumer spending will grow by 7.9%. And I think that's again where we think there's much more longevity to come. So. And healthcare we've spoken about in the past. We still find some very good healthcare companies. Healthcare as a sector has actually been a big contributor to our alpha over the last couple of years. So we're finding good ideas everywhere. We're not totally, reliant on one or two sectors, which is really important, particularly in regard to just the longevity and the consistency of returns we expect to see.
And then I guess just for maybe some people, the underweight to Asia Pacific, that's just a basis on the process and companies either being too expensive or just not having that quality filter? It's
a couple of things. So first of all, our quality bar is so high that there's frankly not that many companies Asia Pac can jump over it. And the second issue is actually around ESG. So when it comes to ESG is quite an important part of our quality test. Now, frankly, I would suggest that a lot of the companies we see in Asia Pac, they're a fair way behind the eight ball on ESG issues, and they haven't really progressed. They haven't got better. Geographically, the European companies they're the gold standard. US companies are catching up fast, but Asia Pac, particularly Japan, it's just still not great, to be honest. And I think there's still a long way to go there. And because there's a shorter universe or smaller universe, they tend to trade on very expensive multiples too.
Yep.
Yeah.
Okay. And then maybe pivoting just to some other characteristics in the portfolio, maybe just some further conviction ideas that you might have as well.
Sure. So if we can just jump to the next page. This really, what I'm trying to do is just, again, sort of highlight some companies that fall under this general theme of the strong getting stronger, which we think is really, it's very evident to us, but it's not that well appreciated by the market. So if you look at these types of names, again, we've just seen these companies get better, get stronger. They've capitalised on adversity of others. Again, they've deployed capital well. And so you look at these companies, and again, I mean, as I mentioned before, the earnings, they've been driven by their actual franchises. The market share has obviously shifted towards them. Cost bases, as much as they've been lowered, I think there's a somewhat simplistic expectation that those cost bases. So, for example, travel and entertainment, every business on the world has been cut in the last 12, 18 months. There's a general expectation that will just bounce back. We don't think that's necessarily the case. We think most businesses will evolve into the way they do business will be different.
Hybrid. Yep.
Everyone will be doing this. We'll be spending less time on planes, et cetera, et cetera. But again, just coming back to my earlier point around this whole idea of earnings leverage, which is just not as well understood as I think will be the case in 18 months' time. But when the cost bases are lower and you see that revenue acceleration, which is still got a long way to play out, the earnings leverage is just huge. It's absolutely huge. And then with that, I think as we start to see that unfold, that earnings acceleration in the second half, it'll then dawn on investors that they should be basically paying higher multiples. So that's the perfect sort of cycle where you're getting multiple expansion and earnings growth.
Yep.
And that's what we all hope for. I've listed some of the companies here. I've called these guys the COVID opportunists. So these are the guys who, again, they've put their shoulder to the wheel. They've taken advantage of the environment. These companies are all a bit different. But if you look at those 6 companies there, they're very, very high quality businesses. We've got very little leverage. Last year, they all had positive sales growth. Again, pretty hard to do. The earnings growth has been exceptional. They all generate very high levels of return on capital. They're all a bit different. Fortune Brands is more a play on the US housing market.
Okay.
So they sell everything from doors to faucets to security products to windows. So it's not just a home builder, but we do think that the US housing market has still got a long way to play out. It wasn't necessarily overinflated pre-COVID, but obviously because people are staying home a lot more, they're more happy to spend money on their homes. Same thematic driving Pool Corp. No secret what they do, but again, like getting a pool not only built but just refurbished. Huge lead times, and so there's a really strong pipeline there. Tektronic is actually a Hong Kong listed company, so they're the guys behind Ryobi and also Milwaukee Tools. Terrific company, very profitable. Doing incredibly well. Thule, very good Swedish company. And again, they're benefiting from all the adventure outdoor activities, so roof racks, bike carriers, that sort of thing. Tractor Supply, that US retailer I've talked about, and people are probably sick of me talking about Yeti, so I won't go on about them again. But again, these companies, they've just gone on from strength to strength, and I think that's historically when you see companies improve their franchise strength, their market positioning, and the profitability, what generally comes after that is multiple expansion. We haven't seen that yet. And I think that's where you see a lot of the opportunity on a going forward basis.
And then I think at this point in the presentation, we might just potentially go to some performance, and then we'll look at some questions as they're coming through. But sure. So with all that wrapped up, you've got the quality score, you've got a high, focusing on those small to mid cap companies. It'd be great for us to walk through the performance.
Sure. So, up the top there, the Bell Global Emerging Companies Funds, our SMID strategy. Look, in an absolute sense, we feel like we've generated some pretty good performance in the last 12 months. We haven't kept up in the last 12 months, and the main reason for that is that because the earnings of our companies didn't get crushed, the stock prices don't bounce as much.
Yep.
And so that's not a huge surprise, but still, I'll take a 29% return any day of the week. And particularly when the companies, again, they're coming out stronger. You stretch it out a little bit further. Our 3-year numbers, we're at 16.8% after fees, so 5% outperformance. And I would actually argue that that's been with probably a couple of style headwinds. So not having exposure to the extreme growth part of the market.
Correct. Yep.
Because of our valuation discipline has been a pretty stiff breeze. Now we think, again, for reasons I explained earlier, going into an inflationary environment where very expensive stocks get beaten up, we think that will go from basically a headwind to more of a tailwind. So we think that's something just to take into account. And then, and really important, it's not on this slide, but the alpha has come from a lot of different stocks. It's not just coming from one, or it's not just coming from Yeti or Tractor Supply. It's coming from a lot of different names, which is really important, and a lot of different sectors. But namely, interestingly, things like healthcare, the consumer sectors, which is a bit contrary to like a lot of the large cap portfolios where it's been very tech driven. And then the Bell Global Equities Fund. So that's our all cap strategy.
Yep.
So investing in large, mid, and small. Again, look, similar thematics. Our valuation discipline's probably been even more of a headwind last couple of years, but we've still been able to generate some pretty good returns over a very, very long period. Again, we've been doing this. That strategy's been going since January 2003. So I've been through multiple cycles there, and since inception, we've added 100 bips per year. I think again, for that strategy, from a style perspective, heading into the next couple of years, we feel like the contributors within the benchmark itself, it's going to be much more diverse.
Good.
So the last, say, 3 years, you've had those FANG stocks have accounted for something like 25%, it might even be more than that, of the total return of the index. So it's been very, very top heavy. But going forward, we think there will be a much more diverse outcome. And so for us as bottom-up stock pickers that aren't basically, wedded to just the FANG stocks, when we own some of them, we feel like there's really good alpha opportunities for us on a going-forward basis. And the last point I'd make is that, and this is coming back to inflationary environments, but our core strategy and our SMID strategy have actually added a lot of alpha historically during periods of rising inflation expectations.
Right.
And one of the reasons for that is that, again, our companies, they've got such strong franchises, they're not price takers. And they've not got huge amounts of leverage in their balance sheets, so therefore the earnings don't get sort of beaten up quite as much. So,
and then I think you did yourself a disservice, but it'd be great to just talk through both SMID and the equities fund, just how it went through COVID, and that the quality of the companies really stood up relative to the benchmark, and performance was quite strong.
Yeah, they did. I mean, again, I think when you think about Q1 last year, when markets really tipped over, you saw that our and clearly like small mid cap stocks, they got hit the hardest as a whole. And one of the reasons for that was actually liquidity. So it was actually the most illiquid parts of the market that the floor just dropped out from beneath them. But against that backdrop, our fund, the Bell Global Emerging Companies Fund, outperformed by a bit over 8%, I think, in that Q1 period. So we held up, we protected capital a lot better. But again, the companies got improved. The earnings didn't fall by nearly as much, as I mentioned earlier. And then the same thing, I think, with the Bell Global Equities Fund, which again has got large caps and SMIDs. We've seen similar themes where you're seeing companies like Home Depot doing incredibly well, Nike just further strengthening their position. And it's across multiple parts of the market, the Estee Lauders of the world. I mean, all those great franchises we know, they've generally strengthened their position. They've capitalised because they've got capitalised by investing in the sales channels more, because they've got the balance sheet to do it. So it's very similar sort of thematic affecting both funds. But on a going forward basis, we feel like the companies are in much stronger position, and we'll see them continue to do really well.
Excellent. Well, we're getting some questions coming through that I might start on. So Peter has written just a question around, I guess, the consumer, the US consumer, and when you're talking to, I guess, the smaller mid company execs, what are they seeing from, I guess, a consumer? Are they willing to take that higher price, or are they willing to hold off on those types of purchases, or is it specific to each kind of stock or sector?
I think the consumer's willing to spend. They're busting to spend.
Yep.
That's the big thing. Clearly, we've all been like we have here. I mean, in the US, they've been in forms of lockdown, various forms of lockdown for a long period of time. But what's happened in the first half of this year is that people are coming out of their apartments and they want to spend. They're generally spending much more money on, I guess, let's call it sort of hard goods, rather than on obviously things like travel, or for obvious reasons. And when it comes to sort of price sensitivity, I don't think you're seeing much price sensitivity at all. Frankly, if you look at the luxury companies, I mean, they are just absolutely killing it.
Yep.
And the same thing happens with, and then there are pockets of focus. So again, anything to do with the home, investing in, improving the home, building pools, and the price sensitivity, I don't think is there quite as much. What will probably happen in the second half of this year going onwards, and starting to happen a little bit now, is more of a shift towards experiences. So there's more travel, going to the movies, more the services part of the consumer economy.
Coming back.
But I think but coming back to the question, the biggest issue that a lot of the companies have got is just keeping enough stock on the shelves.
Yep.
That's probably one of the biggest issues. And there's a whole bunch of logistical reasons related to COVID that prevent that. But demand, very high demand is a big one.
Yeah, fantastic. And then there's one here from Lucy where she's saying that maybe, when you look at how many stocks you have in the portfolio, 44, have you ever gone lower than that? Like where kind of is the sweet spot for the strategy? And, would you ever consider going more concentrated?
We have gone lower than that. I mean, we've got down to, it's typically around that sort of 38 to 45 mark is typically where it is. I think where we end up on the numbers themselves is often a function of the opportunities in the small cap sectors. So in the small cap part of the market, sometimes the positions are a little bit smaller. So that's when the numbers will go up. But to be honest, I'm not sure it's a huge deal either way, because if we just go back to the characteristics page, Matt, the question really comes back to, have I got conviction? And that's really when we have discussions with investors around, numbers of stocks, and what we're really talking about is conviction. Are you actually displaying conviction? Now, this page, the whole idea about this is to demonstrate we show a lot of conviction in that we've got, as much as we've got 44 names, that differential between return on equity between our portfolio and that of the benchmark is absolutely enormous. So I think in some ways it's a reflection of the fact that we're spoiled for choice within the small mid cap universe. Now, if we're in the large cap universe, I absolutely understand why the argument for a much more concentrated portfolio, because there aren't as many opportunities.
Yep.
Frankly, so we've got the great luxury of being able to be a little bit more diversified, and we want to get more diversification from a sector perspective. Again, we don't want one or two things doing all the work.
Yeah, great. And then Glenn's written here, I think looking at this side, we'll refer to it later, but just that ESG overall rating, and it seems to be it is a lot stronger than the actual index itself. It'd be great to kind of maybe dig into that and your kind of thoughts around ESG investing as well. Yeah,
sure. So when it comes to ESG investing, I mean, most people don't think I'll invest in global small mid caps. It's not the first thing that pops in people's heads, but I think when you manage this strategy on a really active basis, you can actually get a really good ESG outcome. And it's not just by screening out stocks. It's not just by investing in what I call the picks and shovels ESG companies, solar and wind. We've got no direct solar and wind exposure, but we've got this phenomenal, outcome. So if you, and just for clarification for everyone on the webinar, those are MSCI statistics. So that overall score, 6.4 versus 5.6. It also equates to a AA rating.
Yep.
You're going to go up to a AAA.
Got it.
But how we've gone about doing it is actually it's been very active. So again, as much as we screen out companies we screen out things like tobacco, coal, uranium, controversial weapons, adult entertainment, companies that are within the UN global norms. But our approach is a much more pragmatic approach. It's not, we don't claim to be impact investors. It's a pragmatic integrated approach where we look at the issue risks that are the most prevalent to the company in question. And for each company in each sector, it's always different. And so we want to look for companies that have got the ability to pull a lever that reduces that ESG risk in question. So I mentioned Thule before. So Thule, so that's a AAA rated company. What they've done on the environmental side is, amongst other things, they've made the choice to invest in such a way that they use 100% renewable energy in all their plants.
Right.
Fantastic. I mean, that's a great sort of positive outcome. I think the other big thing that doesn't get much attention is how these companies addressed social issues during COVID. because during COVID, that was when their employees and their customers were at their most vulnerable. But you take companies like Tractor Supply, they did a phenomenal job. They stepped up. They gave a lot of their staff leave, like additional leave that they paid for and the shareholders paid for. So they didn't have to come to work. They didn't have to put themselves at risk or their families at risk. They gave them a lot more leave. And companies like Home Depot were steering people away from the stores. So, but they didn't all do that. And so I think, the way we think about it, it's got to be integrated. You've got to look at things. You've got to look at the controls where they've got levers to pull. And I think the other big story or point I want to make is that there's investors, I think, always ask themselves that question: is there a performance trade-off? I.e., if I invest in a positive ESG strategy, does it mean it comes at the expense of returns? From our perspective, that's not the case. You can have your cake and eat it too.
Yep.
Like, we feel like we've built a portfolio that is, again, it's got great quality characteristics, but it comes with very good ESG characteristics. So it's really looking at the companies that address those risks very well, and are very pragmatic about it. And the other point I'd make is that our companies, very pleasingly, we've seen this very good, solid uptrend in terms of their overall scores. So the managements of the companies are doing a much better job. They're starting to, really take it a lot more seriously. The quality of the sustainability reports, the alignment with the SDGs that you're seeing coming out of companies has really picked up, which has been terrific to see.
And investors like yourself probably asking the question, and they have a response.
Yeah, absolutely. That's our job, is to hold their feet to the fire.
Yeah.
And really say to them, listen, you guys have got to do a much better job. Not only just telling investors what you're doing. I mean, a good example would actually be Yeti. So we got onto Yeti a couple of years ago and said, listen, you've got a better story than what's being appreciated. You've got to pull your socks up and, talk to the research providers. They bit down hard. They started talking to MSCI, and their first rating was a AA.
Yeah.
Terrific.
Right. Puts you on the radar. Yeah.
Exactly. So, but that's exactly our job, is to engage and to highlight, areas where we think that there are weaknesses, particularly in the sustainability reports, when they don't have enough, realistic and achievable targets there. We'll focus on that. We obviously look at the board. We're looking at female representation within management, employees, and the board. And so there's a whole range of different issues that that's a big part of our job, is to really engage directly with them, not only one-on-one, but also through, some of the other groups in the industry.
Yeah, great. And then I've got one here from Sophie, who's we've talked about the positive tailwinds.
Yep.
But, are there what are maybe some potential risks that you see in that SMID space, or, what could maybe, investors look for in some headlines if there are risks that might appear?
I think you'll see more volatility in earnings as a whole.
Okay.
So, I've spoken today a lot more about our brand or our flavour of SMID.
Yep.
But then outside of that, there's a much bigger universe of companies that have got a lot more volatility in their earnings. So clearly, I hate to keep coming back to it, but rising interest rates and rising inflation, where we haven't seen that for a while, that can be a bit of a jolt to earnings, because we've seen, a lot of companies. We've obviously seen it large cap, but in the SMIDs, you've seen a lot of companies where they borrow money, buy back shares, borrow money, buy back shares, and that's been a big part of why they've grown earnings. When interest rates start ticking up higher, two things happen. That growth rate flattens out.
Yep.
Number one, and then number two, you just start to see that the interest costs have a much bigger impact on earnings. So, at what I'd call the junk or the value end of the market, that's where you're probably going to see that risk a little bit more. Clearly, COVID is still with us, unfortunately, and you can't look away from that, unfortunately. So that could be a bit of a handbrake to the growth trajectory, but more so in the companies that are very economically sensitive.
Yep.
So again, it's sort of like we've got some exposure, like obviously some consumer exposure, some industrials exposure, but for the most part, those companies that are very economically sensitive, I wouldn't get too far over your skis in terms of earnings expectations for next year, because there's still probably a bit more volatility. So those would be a couple of the key things, I think, that I'd be on the lookout for. And then clearly, last but not least, but with markets where they are now, it's just that valuation risk. You just can't. You just got to be very disciplined on that.
Great. And then I've got Lucy that's written one more question just around do SMID companies, and maybe it's the process that builds this out, and you said you didn't like to use the word moat, but do these companies have a wide enough kind of competitive advantage to remain competitive, or do you see an M&A cycle maybe start up again?
I think, Matt, if we can just turn to page 5, just back one. So the first thing I'd say is that the moats in all these companies, they do have they have very good franchises. The TAMs, the total addressable markets of a Yeti is obviously not as big as Nike, for example, or something with Thule. It's not as big as, another company, but they tend to have very big market shares within their TAMs. So therefore, the pricing power is phenomenal.
Got it.
And that's probably got a little bit better. But so I think from a standing start, they've all got very strong moats, and to my earlier points, that we think they've net got stronger. From an M&A perspective, because luckily these companies have all got great balance sheets and they can deploy capital. It becomes a question of to trade off between deploying capital into organic growth opportunities, number one, and or number two, M&A. And so you sort of see a bit of both, I'd say. I don't think you'll see our types of companies making big strategic M&A, moves in the next little while. It tends to be much more incremental add-on M&A things. So that's what we'll probably see a bit more of, unless we go back into a period whereby the economic recovery stumbles and you see some companies getting into real trouble, and that's where you might start to see some of these companies do a little bit of M&A. But we're not counting on it. We're assuming that the vast majority of the growth that we'll see will come through, it'll be predominantly organic growth, and then from M&A it'll be much more opportunistic tuck-in.
Okay. Well, in the interest of time, Ned, thank you very much for your time. We will be sending a recording of this conversation out to everyone, and we'll be sending the slides as well. If you have any further questions, please reach out to me, or you can see some my colleagues and their names and numbers on the screen. Ned, thanks again, and to everyone, keep well and keep safe, and we'll see you soon. Thank you.
Great.